Okay, let's unpack this. We're about to kick off a deep dive into the Q4 FY25 earnings review from NSE.
Right?
This is straight from the latest Market Pulse report, published just this June 2025. Our mission today really is to cut through all the data, pull out the most important nuggets of knowledge from this pretty detailed report on the Nifty 50 and Nifty 500 companies.
Yeah, give you that shortcut.
Exactly. Give you a valuable shortcut to being well-informed and maybe highlight some genuinely surprising facts you might not have caught otherwise.
That's right. And this report, it gives us a really crucial snapshot, doesn't it, of how India's leading companies performed. We're talking revenue, operating profits, overall profitability.
Right.
But it's not just looking back. We'll also be, peering ahead a bit, looking at future earnings estimates, and importantly, the macroeconomic factors that are really shaping the market landscape right now.
Okay, so let's start at the top then, the top line story. Revenue growth in Q4 FY25. What did we see?
Well, for the Nifty 50 companies, they saw about 6.4% year-over-year growth.
Okay, 6.4%. That's up from the 5% in Q3, right?
It is, yeah, a noticeable step up.
Yeah.
And the Nifty 500 companies, they also showed improvement, 5.7% year-over-year growth. That's up from around 4.7% the previous quarter.
And what really caught my eye, maybe a bit of a surprise, was the Nifty 50's quarter-on-quarter rebound. It hit 6.1%, which is apparently the highest in 12 quarters.
It is, and that's definitely positive, that quarterly rebound. But, we have to put it in perspective.
Okay.
This marks the fourth consecutive quarter of just single-digit growth for the Nifty 50.
Fourth straight quarter. Wow.
Yeah, and for the Nifty 500, it's an even longer stretch. Their eighth straight quarter of single-digit growth.
8 quarters. So that really underscores a kind of continued weakness then in that top-line momentum.
Exactly. It means companies are, well, still finding it a bit tough to significantly expand their sales. That big growth isn't quite there yet.
And what about the full year, FY25 overall?
So for the full year, revenue growth was 7.2% for the Nifty 50 and 6.8% for the Nifty 500.
Yeah.
Large caps within the Nifty 50 were really the main drivers there. Companies outside the Nifty 50, they saw slightly lower growth, around 6.1%.
And it's interesting, the report notes the Nifty 50's full-year revenue growth actually moderated to a 4-year low.
That's a key point. It tells you that even with that recent quarterly uptick we mentioned, the broader, longer-term trend for India's top companies is still one of slower revenue expansion.
So let's get into the details. Which sectors were driving things within the Nifty 500 in Q4?
Right. So drilling down into the Nifty 500 for Q4, the key drivers of net sales growth were financials, big contributor, over 18%.
Okay.
Then you had materials at about 15.1%, consumer discretionary close behind at 14.7%, and industrials at 13.1%.
So those 4 were the heavy hitters.
Absolutely. Together, those 4 sectors, they were the powerhouse contributors. They accounted for more than 60% of the entire increase in net sales for the Nifty 500.
And if we zoom in just on the Nifty 50 companies specifically, any interesting trends there?
Yeah, within the Nifty 50, healthcare and communication services were the only 2 sectors managing double-digit year-over-year growth.
Only 2?
Yeah. And energy, largely, pushed by Reliance Industries, it notably posted its strongest revenue growth in 9 quarters year-over-year.
That's significant for energy.
It is. And materials also showed impressive strength. It hit its highest growth in 10 quarters.
Okay. But it wasn't all good news, right? Some sectors lagged.
Exactly. And this is where it gets quite fascinating, maybe a surprising divergence. You contrast those strong performers with sectors that saw slower growth or even weakness.
Like?
Well, consumer staples, for instance. They face pretty subdued revenue growth, especially hit in urban areas. That points to sort of persistent weak demand there.
Okay. IT sector, too.
IT sector also remained, well, tepid. That's mostly down to the slow global demand we've been seeing.
Right.
But let's just focus on energy for a second, because this is interesting. While the Nifty 50 energy sector grew, as we said, a healthy 6.7% year-over-year, the broader Nifty 500 energy sector actually declined. Right. By over 3% year-over-year.
Declined. Why the difference?
Well, it seems largely impacted by weaker margins and reduced discounts on Russian crude for that wider pool of energy companies outside the very top ones.
Huh.
So this raises an important question for you listening in. Why such a big difference between the top 50 and the broader 500 in the same sector? What does that tell you about maybe the underlying makeup or resilience of those different groups.
That is a sharp observation. And it actually leads us perfectly into the next finding, which is, well, a bit of a silver lining, I guess.
Oh, okay.
Here's where it gets really interesting. EBITDA growth, operating profits. They actually outpaced revenue growth in Q4 FY25.
Yes, that's the key takeaway on efficiency.
For the Nifty 50, we saw an 8.5% year-over-year increase in EBITDA. And for the Nifty 500, even stronger, 9.4% year-over-year.
Right.
So even with sales growth being just okay, companies found ways to be much more efficient.
Precisely. And the why behind that strong operating profit growth, it's really a combination of factors.
Such as?
Easing input costs definitely helped. We saw impressive cost efficiencies pretty much across the board. And the benefits of operating leverage kicking in as companies optimize their existing setups.
So better margins then.
Absolutely. Consequently, margins rose to multi-quarter highs. The Nifty 50's margin hit a really impressive 22.1%. That's an 18-quarter high.
18 quarters. Wow.
And the Nifty 500 reached 19.2%, which is a 6-quarter high for them. So yeah, companies are squeezing more profit out of every rupee of revenue.
But hang on, the full year picture for EBITDA wasn't quite as stellar for the Nifty 50, was it?
No, that's true. When you look at the full year FY25, the Nifty 50's EBITDA growth actually slowed to a 5-year low of 5.9%.
5-year low?
Yeah. Though its margin, interestingly, still managed to hit a 4-year high of 21.8%.
So the Q4 efficiency boost was strong, but the annual trend still reflected a tougher overall environment.
Exactly. Now, let's highlight the sectors that were the real powerhouses for EBITDA growth within the Nifty 50 in Q4.
Okay.
Communication services contributed a massive 28% of the growth.
28%.
Yeah. Followed by materials at nearly 16%, utilities over 15%, and industrials almost 14%.
So those four, again, really driving things.
Critically, yes. Those 4 sectors collectively contributed over 70% of the total operating profit expansion. But get this, they only accounted for about 30% of the overall revenue growth.
70% of profit growth from 30% of revenue growth.
Exactly. That is a clear, compelling sign of exceptional operational efficiency gains. It shows just how well they manage their costs relative to their sales.
And on the flip side, IT and consumer staples.
In stark contrast, yeah. Sectors like IT and consumer staples made far more modest contributions to EBITDA growth, less than 3% for IT and under 1% for consumer staples. Clearly indicates the tougher demand conditions they're still navigating.
Okay. What about the broader market, Nifty 500, excluding the top 50?
Now, if we broaden our view there, we actually see even stronger EBITDA growth. 10.4% year-over-year in Q4 for the Nifty 500 x Nifty 50 group.
Higher than the Nifty 50 itself.
Yes. And their margin expanded, too, to 16.5%. And for the full year, FY25, they delivered a healthy 12.9% year-over-year growth.
So that really shows the underlying strength in cost management across the board, not just the giants.
It really does. It suggests that operational discipline is a pretty widespread trend right now.
All right, let's move down the line. Profit after tax, PT. You mentioned earlier this presented a maybe more mixed picture.
Yeah, PT was a bit more, let's say, nuanced. The aggregate PT for Nifty 50 companies grew a pretty muted 0.8% year-over-year in Q4.
Just 0.8%. Wow, that feels like hitting the brakes after that EBITDA surge.
It does seem that way. And it marked its second lowest growth rate in the past 10 quarters for the Nifty 50 PT.
So why was the Nifty 50 PT so muted?
Well, if we unpack the reasons, we saw actual declines in PAT for the consumer and energy sectors within the Nifty 50.
Okay.
And there was also a high base effect playing out in financials from the previous year.
Right, the comparison was tougher.
Exactly. But despite this muted growth, Nifty 50 PP margins still managed to reach a multi-year high of 12% in Q4.
12% margin, even with low growth. Interesting.
It is. And if we connect this to the bigger picture, it suggests that while those operational efficiencies did translate into better margins, the overall profit growth for the Nifty 50 was ultimately held back by the underperformance of a few specific large sectors.
Okay, but what about the broader market, the Nifty 500?
Right. So contrast that with the Nifty 500 picture. Their overall patent expanded a strong 9.5% year-over-year.
Much better.
Much better. And here's a really important distinction. Nifty 500 firms, excluding the Nifty 50, they delivered a really robust 20.7% PAT growth.
Over 20%.
Yeah, their highest in 5 quarters. So real momentum there.
Yeah.
However, their PAT margins trailed behind at 9.1% compared to the Nifty 50's 12%.
So the smaller companies grew profits faster, but the bigger ones were still more profitable per unit of sale.
Precisely. And this raises an important question for you, our learner, to think about.
Yeah.
What does this all mean? Well, it really underscores the relatively stronger operating leverage and overall profitability, that margin strength, of the large-cap Nifty 50 companies. Even while the non-Nifty 50 companies are showing truly impressive growth momentum in their actual profits.
And mid-caps played a big role here too, right?
Huge role. It's definitely worth noting the Nifty mid-cap 150 companies contributed a significant 78% to the total year-over-year pay growth for the broader market group.
78%. That's massive. It shows where a lot of that profit expansion is actually coming from.
Absolutely. A very powerful signal.
And just to wrap up the pay-T numbers, what about the full year FY25?
For the full year, the growth was fairly consistent, actually. 5.5% PPAY growth for the Nifty 50, 5.6% for the Nifty 500, and 5.8% for the Nifty 500 ex-Nifty 50 group.
So despite the Q4 nuances, the full year showed pretty similar, albeit moderate, profit growth across the board.
That's right, which leads us into the outlook.
Right, because it means that even with some better-than-expected Q4 earnings, especially on the efficiency front, consensus profit estimates for the top 200 companies have, kind of surprisingly, continued to be revised downward.
They have, yeah. FY26 estimates got trimmed by 3%, and that translates to projected earnings growth falling quite a bit, down to 12.8% from an earlier 17.4% forecast back in March.
Ouch. And FY27?
FY27 estimates also saw a cut, about 2.1%.
And this shows up in the earnings revision indicator, the ERI.
It does. The ERI remains in negative territory, currently at minus 0.38.
Meaning more downgrades than upgrades are still happening.
That's what it signifies, yes.
But why the continued downgrades if Q4 showed some resilience, particularly on margins and from the broader market?
That's the key question, isn't it? The report tells us these revisions were quite broad-based across sectors, but they were led particularly by downgrades in energy, consumer discretionary, and information technology.
So continued caution about those specific sectors, it seems.
It suggests a cautious outlook there, yes.
Yeah.
However, here's an interesting little twist.
Okay, despite that negative ERI number, the report does note some recent signs of recovery in the revision trends.
Ah, so maybe the worst is over.
It suggests the downgrade cycle might, just might, be bottoming out, which is a crucial point, right?
Yeah.
It implies we could be nearing the end of these negative revisions.
Okay, so if the downgrades might be easing, what about the bigger picture? What supportive factors could help turn things around and actually bolster future earnings?
Right, connecting it to the macro picture. The report points to several potentially strong domestic tailwinds.
Like the RBI rate cuts.
Exactly. The RBI's cumulative 100 basis point rate cut. That directly lowers borrowing costs for businesses, should make capital spending more attractive.
Makes sense. What else?
Well, there are also some tax relief measures mentioned, easing inflation trends, which helps both consumers and businesses, and, importantly, the forecasts of an above-normal monsoon.
Ah, yes, the monsoon. Crucial for consumption. Hugely important. Expected to significantly boost rural consumption. Then on the investment side, you've got continued public capex, government spending, plus those lower funding costs we mentioned, likely spurring more private sector spending too.
So quite a few domestic positives lined up.
There are. Yet, it's definitely not all smooth sailing. The report is clear about significant downside risks too.
Like global factors.
Primarily, yes. Global geopolitical tensions remain a big concern, obviously, and any trade-related risks could definitely impact external demand for Indian goods and could also mess with commodity prices again.
Always something to watch. And looking forward, which sectors are expected to carry the load in terms of earnings growth?
Looking ahead, the projections are that financials, energy, and materials will be the primary drivers. They're expected to account for nearly 62% of the incremental earnings growth over the next 2 years.
Financials, energy, materials. Okay.
Yeah, those three are pegged as the big contributors.
So wrapping this all up then, what does this really mean for you, our learner, trying to make sense of the market?
Well, it's certainly a nuanced picture, isn't it? A mixed bag, really.
Yeah. We've seen, okay, a modest top-line recovery, maybe some green shoots there. Then these really impressive widespread gains in operating efficiency. That was a clear positive.
Definitely.
But then, mixed pay in our results. The Nifty 50 was muted, but we saw that stronger performance coming from the broader market, especially outside the Nifty 50.
That divergence is key.
And all of this is happening against a backdrop of these persistent downward earnings revisions.
Though potentially bottoming out.
Potentially bottoming out, yes. And supported by some potentially powerful macroeconomic tailwinds domestically.
So, to encourage your critical thinking here,
Yeah.
the report paints this really complex, but I think fascinating picture. While that large cap profitability, those margins remain strong.
Mm-hmm.
The underlying operational efficiency across the board and that robust growth impulse coming from the broader market, particularly the mid caps, those are really crucial elements. They'll shape the path forward.
It's definitely not just about the headline Nifty 50 number then.
Not at all. You have to look at where the efficiency is coming from and where the actual profit growth truly resides.
Okay, so here's a final thought for you to chew on as we finish this deep dive. How might that undeniable strength we saw in operational efficiency and that really robust mid-cap growth, how might that actually counteract the overall softness in revenue growth and those, well, still negative earnings revisions we observed?
That's the central tension, isn't it?
And how will those domestic tailwinds, the rate cuts, the hopeful monsoon forecasts, how will they interact with those ongoing global geopolitical uncertainties to really shape the market's trajectory in the coming quarters?
Yeah.
This deep dive, I think, really shows us that the full story is always more complex, it's filled with these unexpected dynamics, and ultimately it's far more interesting than just the initial headlines suggest.